Imagine waking up on a Wednesday morning, making yourself a coffee, and knowing that while you slept, your portfolio sent you a paycheck. No boss, no alarm clock, no commute, just income that shows up whether you work that day or not. That is what living off dividends actually looks like. And today I'm going to show you exactly how much you need invested to pull it off in America, because the math is more achievable than most people think. And there are some quirks of the American dividend system that most people never fully understand. Things that significantly change the number you actually need. So let's run through all of it. Let's start with the most important question. How much do you actually need to live in America? The answer obviously depends on where you live and how you want to live. But let's use some real benchmarks. The Economic Policy Institute's updated 2026 Family Budget Calculator shows that a single adult needs roughly $60,000 to $75,000 per year in a mid-cost city just to cover basic necessities: rent, food, transportation, healthcare, and other essentials. A comfortable two-person household typically runs $90,000 to $110,000. And if you want the full version, eating out regularly, taking vacations, upgrading things when you want, you're looking at $120,000 or more depending on your state. These numbers are meaningfully higher than they were just a few years ago, and they reflect where costs actually stand in 2026. For this video, we'll run the math on three numbers: $60,000 a year, $90,000 a year, and $120,000 a year. Those cover the realistic range for most Americans targeting dividend freedom in today's economy. Now here's where the American system gets a little complicated, and this is the part most people gloss over. In Australia, there's a system called franking credits that essentially refunds you the corporate tax a company already paid on its profits before sending you a dividend. America doesn't have that. In the US, you get hit twice. Once when the company pays corporate tax on its profits, and again when you receive the dividend as personal income. The good news is that qualified dividends, which covers most dividends from established U.S. companies held for more than 60 days, are taxed at preferential rates. If your taxable income is below $49,450 as a single filer in 2026, your federal tax on qualified dividends is zero. Between $49,450 and approximately $533,400, it's 15%. Above that, 20%. That 0% bracket is significant. It means if dividends are your primary or only income, you can engineer a situation where you pay very little federal tax on a meaningful amount of income. That changes the real number you need, and we'll come back to it. Now, what kind of yield can you actually expect from an American dividend portfolio? The S&P 500's dividend yield in 2026 sits around 1.05%, near an all-time low. Index investing alone won't get you there on a reasonable asset base, but a portfolio built specifically for dividend income tells a very different story. Dividend-focused ETFs and blue-chip dividend payers typically yield between 3% and 5% on a diversified basis. If you go heavier into high-yield names, REITs, utility stocks, dividend-focused ETFs, you can push that to 5% or 6%. And some individual high-yield positions go higher than that, though we'll talk about why chasing the highest number is usually the wrong move. For our math, we'll use 4% as a conservative, realistic yield for a well-built American dividend portfolio. It's achievable, sustainable, and doesn't require taking excessive risk to get there. So let's run the numbers. At a 4% yield, if you want $60,000 a year in dividend income, you need $1.5 million invested. For $90,000 a year, you need $2.25 million. And for $120,000 a year, you need $3 million. Now, if you're willing to build a slightly more yield-focused portfolio pushing 5%, those numbers drop to $1.2 million for $60,000 per year, $1.8 million for $90,000, and $2.4 million for $120,000. Those are the targets. Now, let's talk about how to actually get there. The path most people miss is compounding. You don't need to save $1.5 million from scratch and then start investing. You invest consistently over time, and the returns do the heavy lifting. If you invest $1,500 a month into a diversified dividend-focused portfolio, averaging a 7% total return, which is well below the long-term U.S. market average of around 10%, you'll cross $1 million in roughly 22 years. Bump that to $2,000 a month, and you're there in about 19 years. Start at 28, and you're financially free before you turn 50. The other lever most people underestimate is account structure. Where you hold your dividend-paying investments matters enormously in America. Inside a Roth IRA, dividends grow completely tax-free, and qualified withdrawals in retirement are also tax-free. That's the most powerful structure for long-term dividend investors. A traditional IRA or 401k defers the tax, which still helps your compounding significantly, but creates a tax bill later when you withdraw. A regular taxable brokerage account gives you the most flexibility. You can access the income at any age, but you pay taxes on dividends as they arrive. Most serious dividend investors run a combination of all three. Roth for long-term compounding, taxable account for income that can be accessed before retirement age without penalty. Now here's the part nobody wants to hear, but it's the most important thing in this video. Chasing the highest yield is the single biggest mistake new dividend investors make. If you see a stock yielding 12% or 15%, be very suspicious. Almost always, one of two things is happening. Either the stock price has collapsed because the business is in trouble and the yield looks high because the denominator is broken, or the company is paying out more than it earns and is about to cut the dividend. Either way, you're walking into a value trap. The yield looks great right up until it doesn't. The companies that have paid growing dividends for decades are the boring ones. Johnson & Johnson, Procter & Gamble, Coca-Cola, Realty Income, PepsiCo, Verizon, the major utilities. These companies have paid and grown dividends through recessions, pandemics, financial crises, and wars. They're not exciting, but they pay you forever. And forever is the goal. There's also a category of stocks specifically worth knowing about for dividend investors. Dividend aristocrats. These are S&P 500 companies that have increased their dividend every single year for at least 25 consecutive years. There are currently 69 of them, a record high. They don't have the highest yields, but they have the most reliable track records of growing income over time. A portfolio of dividend aristocrats has historically outperformed the broader S&P 500 on a risk-adjusted basis over long periods, while providing income that grows faster than inflation. Speaking of inflation, this is the part most dividend discussions skip over, and it's critical. If you need $60,000 to live today, you'll need around $80,000 in 10 years and roughly $108,000 in 20 years, assuming 3% annual inflation. A dividend portfolio that pays a flat $60,000 forever is actually a shrinking portfolio in real terms. This is why dividend growth matters as much as current yield. The reason high-quality dividend stocks work long-term is that the best companies grow their dividends faster than inflation. Johnson & Johnson has grown its dividend at roughly 5.7% per year over the past decade, and has now increased its dividend for 63 consecutive years, making it a dividend king. Realty Income at around 4 to 5%, Procter & Gamble at around 5 to 6%. Those growth rates keep your purchasing power intact and in many cases growing over time. Now there's a smarter way to build this than picking individual stocks from scratch, especially when you're starting out. Dividend-focused ETFs do the heavy lifting for you. VYM, Vanguard High Dividend Yield, ETF, gives you around 500 high-yielding U.S. companies with a current yield of approximately 2.2%. It's one of the most diversified dividend ETFs available, with an ultra-low 0.04% expense ratio. SCHD, Schwab, U.S. Dividend Equity ETF, is one of the most popular dividend ETFs in America, yielding around 3.0% to 3.5% with a strong history of dividend growth, over 10% annual dividend growth over the past decade. DVY, iShares, Select Dividend ETF, runs higher, closer to 4.5% to 5.5%, with heavier weighting toward utilities and financials. And for income investors who want monthly rather than quarterly payments, JEPI, the JP Morgan Equity Premium Income ETF, delivers monthly distributions at around 7% to 8%, though the strategy involves options writing rather than pure dividend capture. Note that JEPI distributions are generally treated as ordinary income rather than qualified dividends, which matters significantly in a taxable account. For most Americans, a simple 2 or 3 ETF dividend portfolio will outperform the vast majority of individual stock pickers over a 20-year period, and you'll sleep significantly better. One more thing worth knowing: how the money actually arrives. Most American dividend ETFs and stocks pay quarterly. Some, like Realty Income, pay monthly. Building a portfolio that staggers payment dates across the quarter means income arrives more regularly rather than in 4 large chunks per year. Some dividend investors build what's called a dividend calendar, mapping out which holdings pay in which months, so the transition from salary income to dividend income feels smooth rather than lumpy. And while you're still in the building phase, there's one more tool that dramatically accelerates the process: the Dividend Reinvestment Plan, or DRIP. Instead of taking your dividend payments as cash, you automatically reinvest them back into more shares of the same stock or ETF. Your shares pay dividends. Those dividends buy more shares. Those new shares pay more dividends. The compounding effect is exponential over long periods, and the difference between a drip investor and a cash-out investor over 20 years is enormous. You flip the switch from reinvesting to spending when you're ready, and by that point, your portfolio is producing significantly more income than it would have been if you'd been spending along the way. So let's bring it all together. To live off dividends forever in America in 2026, you're realistically looking at between $1.5 million and $3 million invested, depending on your lifestyle and how yield-focused your portfolio is. You can hit that target by investing consistently into quality dividend stocks and ETFs, using tax-advantaged accounts like a Roth IRA to shield as much of that income as possible, avoiding high-yield traps in favor of sustainable dividend growers, and giving compounding the runway it needs to work. The qualified dividend tax rate, especially the 0% bracket for single filers earning under $49,450, means your actual after-tax income from a well-managed dividend portfolio can be significantly higher than it looks on paper. The dream of waking up on a Tuesday and having your portfolio send you a paycheck is not reserved for people who inherited money or made a fortune in tech. It's math. Consistent math, applied over enough time, with the right structure underneath it. And the earlier you start, the more time that math has to work in your favor. If this video helped you get clear on the numbers, drop a comment letting me know where you're at in the journey. Just starting, halfway there, or already living off dividends.